Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen, and today another time for Cycles TV. I'm happy to have you here. Today I decided I want to follow up on what we discussed last week. Monday related to correlation score. What is the correlation? Why correlation between price and cycles is not as important, and maybe there are different and better tools to do that. So the focus is more a little bit on approaches, methods. But before jumping into that, for sure, let's have a quick look on the S&P, the US markets, to have the latest dynamic cycle update, at least for the first 5 to 10 minutes. For the ones just interested in some market cycles. But after that, I will directly jump into the discussion about what is the RSD running slope difference test. What is that? Why is that important? Why will this show up in the application? So that's the purpose for today. Thanks for joining me again. At the end, for sure, as always, I will take the time to go through your questions and let's look through it. So, topic number one, let's update the S&P. Last week I did an analysis. Looks like that a top could be in. So at least for that point in time, we followed through. That's the current and latest data. So let's update our analysis here. So at the bottom, you see the latest cycle analysis. Let's make this even larger. So here we are. We see our spectrum here at the bottom. It looks quite similar to what we had last week. So no big change in regards to the dynamic daily cycles we've seen last week. You can also follow up on last week's video. So the important cycles are, and it gets more and more interesting here, the cycle with a length of 81 trading days. Yeah, you see it's showing up here. It's also selected as key dynamic cycle from our artificial guidance, or at least from the visual shape of the spectrum. That's what our computer guided ranking score is doing. Then we have 2, 3, 4 additional cycles, which could come into the decision-making process here for us. But if we look at the rankings, I would maybe go with the third. It's hard to judge, so we need to combine it. So let's first start with the 81 trading day cycle, which is here on the screen. We discussed the top, which looked like to be in last week here. We have a follow-up now approaching the midpoint from the cycle, which would project more downward potential of this cycle moving into September, so for the next 4 weeks to come. That's the short-term view. You see, if you just have a look at the cycle swings from the past, they are nicely aligned with the major timing information about the turns. However, we skipped the cycle swing here in March, April, but I often referred to that period as a tough period for cycles. So the question is now, are we back in sync with this current short-term daily dominant cycle? If yes, then we could see a follow-through until mid-September. So we need to confirm now a little bit if we can trust this cycle or not. So therefore, we bring in our additional measurements. First, let's build a composite cycle model based on the most important cycles, which show up in the spectrum here. So we pick the other cycles here just by ranking. So I will not comment on, and I will activate and deactivate these cycles now step by step. And please have a look on the next projected timing information we are looking for. As you know, we are not looking for price projections. We are not looking for 2 or 3 repetitions into the future, we are looking into what's the next important projection. It's a downward swing. If I now activate the second cycle with the length of 105 trading days, you see here now I will activate and deactivate, you see that our future projection will not change. Yeah, so it really doesn't matter if we put this cycle into the mix or not. For sure, from an historical perspective, it will fit better to the past data. But however, we are not interested in past data. We are interested in how valid and how stable our projection is. And therefore, I said it's just a confirmation. It's more or less projecting the same information, a possible bottom in September. So let's then switch to the other cycles, 125 trading days. Also detected here. You see I activate, deactivate. So it's quite interesting. Have a look at this point here. Now you see it, activate, deactivate. Also, this seems to have the same basic rhythm, which seems to synchronize the possible bottom mid-September. And now let's do the same for the fourth cycle with a length of 180 trading days. Activated. You see the same. So that's quite interesting, by the way, that we have 4 key cycles which show up in the spectrum. And I have now switched on and off each of these 3 cycles in addition to the most dominant cycle. And you see here just that the projection is very stable, even if we just use one cycle or a combination of the most dominant and the other cycles. The forecast projection is not changing. And that's a very good information. There are situations when you will see this forecasted composite cycle just flip around if you have 2, 3, or just one cycle, which give you a tough time or tough decision-making process which to pick. In that case here, we can also activate now all cycles, I think, and as you can see, it will not alter our projection here. Yeah, now I have activated all 4 cycles into this composite cycle, and you see the same projections as by just using one dominant cycle. Mid-September, all cycles project a possible bottom here, which is good. So therefore, that's what I said. We need to validate if we can trust this projection, yes or no. So now referring to the most important cycles here, looks quite supportive. Another topics now we need to bring into play to validate if we can rely on such kind of projection. Let's just simplify it by just bringing up this one cycle here, is what I always refer to as now adding technical information derived from the price data. So using technical indicators, as you are all aware of, just tuning them to the rhythm. So using the length parameter for technical indicators derived from the dominant cycle. That's what I'm doing here. And we have included one of the favorite indicators, which is the cyclic smooth RSI. And just by activating this information, it will show up as an indicator here at the bottom. And let's have a closer look at what the reading of this information gives us here. So I showed you last week that it looked like we had a good confirmation of a possible top in the markets just by looking at that the indicator crossed below the upper band, yeah, which we had tough times here in April, which was more or less the where the cycles have gone out of sync. Then we stayed above this upper band for a long period, and then a clear break below the upper band, which was coming in confirmation with the 80 trading day cycle. So now you see that we are in the running downswing of this cycle here. We are now approaching the lower band, but just approaching. So my learning is from the observation of this kind of indicator is when we cross the lower band from the upper perspective, it's just a confirmation of the downward momentum which is in play. So when we cross here, let me just paint it. When we will cross below, these lower band, which might then maybe go that way here, this, at least for the first crossing below, is a confirmation of a downward movement. So it might then give you the confirmation that more downward momentum is coming into the market. And then when it reverses, yeah, and then it crosses back from the downside to the upside. That's the point where we will look out for a possible bottom. So this could now be interesting to see if we will stay or cross below the lower band, stay there maybe until mid-September, and then see mid-September the crossing from below the lower band to the upside, which would give a perfect match between technical analysis, analyzing price, and the cyclic timing information here. So therefore, I think it's just a confirmation what we discussed last week. Seems like, and as I always said, I was waiting for a final downward push into late summer. So let's watch how this unfolds. And just to add to the mix, to confirm maybe even this cycle, you know that we have built into the FLD, the concept of FLDs. We can plot FLDs, which is a quite simple concept, but just to plot the FLD based on the 80-day cycle, which then brings us to bringing the number of 40 for this FLD, you see that we, let me remove the cycle for a second here, just having a view on the FLD. You see here that we're at a very important point in this analysis. So the green line is the FLD, according to the dominant time cycle here, and price is now at exactly the FLD line. We crossed below it. We have come now to the upper, so it's a decision point here. Yeah, when we cross really below this FLD line, then we also have another confirmation from the concept of FLDs that we have arrived at the midpoint of the cycle. So if this happens, so we need to see at least sideways movement. So what we need to see in the markets is we need to have a little bit sideways movement, yeah, or downward movement. And then during the next days, we will more or less confirm that we are below this FLD line here. So if this takes place, then we also have confirmation from the concept of a future line of demarcation, that the downswing cycle is in force. So it's a confirmation of the downswing which started here. And once we have this confirmation in, we can then set a price target and a possible time target. So the price target will be just measuring the distance from here and adding this up to here, which, and we see it here also on the chart. It's not this one here, but this would bring us to around downward projection of around 4,100 in the S&P if the downswing now continues. So another 5 to 6% to the downward, at least following that cycle. So yeah, this was just a quick update on the current dynamic daily cycles, which seems to be active in the US stock markets. And that's, as always, you know, you will get an update on current cycles, what we see in the markets, and that's it. That's what we see using our platform here in the Foundation for the Study of Cycles. You are invited, if you're new, becoming a member. That's exactly what you can do with the tools we offer at the Foundation for our members. Second topic, and that's more science related for the members or friends of cycle analysis and cycle research, and improving methods how to do cycle analysis. And I want to spend the next 10 to 15 minutes talking about the RSD t-test in specific. So it has been developed from climate time series analysis, because also in climate temperature data, it's always important to detect trend changes. Yeah, I mean, it's a key thing to discuss in all these climate discussions. Do we have a trend change in the global temperature, global warming? So do we see a real trend change? And not only that, we need to detect different trend changes. So there's not only one trend, there might be different trends. And so therefore, in the area of science, there's always discussion about different methods how to detect a trend and a trend change in the underlying data series. And during the last, I would say, 3 years, a new method, a new kid on the block, however you want to call it, has shown up. This is related to the RSD t-test. I introduced it last week. Maybe you have read about it from last week to this week. So today I want to spend some time on that. And I want to talk about why this is important in relation to cycle analysis, because trend and cycles go in sync. And if you just think about shorter term trends, which is just one leg of a cycle, yeah. So it's not about the long term trend and then short term cycles. You could also think about detecting short term trend changes. And if we are able to detect short term trend reversals, this could be matched with one cycle leg or one leg of one cycle. So, we have one cycle consists of an upswing and a downswing, so which would be similar to two trends, an uptrend and a downtrend. And if this matches the cycle length, we could use methods on that. And there are different approaches ahead of us. But first, what is the RSD test? So let's spend some minutes on that discussion. I've put a link here in the video on the scientific articles which are out there and available on that. So it's also called a new statistical method for detecting trend turning. Yeah, so it's not developed by us. It's coming from the applied climatology. You find the articles out there on your own. But at least they are providing a lot of research why this method is important. I will not go into the math here. It's not an easy calculation, so just trust me, you will not find this method in any charting application moving forward, because I think it's quite too complicated to code this into just a simple indicator. But we have it in the platform just shortly. But let's get back to the topic first. That's what the method more or less is about. If you see these pictures here, let's spend some time on this message here. This is just some demonstration data. Yeah, so the black data is just some random data they used for the analysis, and you see here that the running slope difference test, that's the method we are talking about, is just used to detect these trend turning points in the underlying data set. And once these trend turning points have been detected, at the bottom here, you can see that you can define the underlying different trends. So it's not just one trend here. Yeah, you see that different trends are identified in the data set here on the left hand side. So and the distance from these lines here represents the length of this trend. So, and that's the beauty of this method. It's able to derive different trend length and changes in this data set, and different points of trend changes, which is also a key aspect of this method. So let's also discuss what trend changes are detected by that method. Give me a second to pull this up. Let's keep an eye here for a second. So, as I said, it's not only just one trend we are looking for. So we might have trend changes in regards to a shift between a significant uptrend switching into a significant downtrend, which you could call a major cycle turn, switching from an uptrend to a downtrend. But then if you follow this channel, I often refer to that, it does not always mean that we need to change from a running uptrend to a running downtrend, at least if we talk about shorter term trends. And there's a different turning point, which is here to the right-hand side. There's also a possible turning point if we turn from no trend to a significant trend, which means maybe we have moved sideways and then a trend changes to the upside or to the downside. And that's also a turning point in regards to a trend change. Yeah, so coming from a flat a movement into an upward or downward movement is a change in trend turning. And that's if you just have the shape of a theoretical sine wave cycle in mind, yeah, which is going up, down, this could be irritating, because also if we switch from a sideways movement to an upward or downward, this is related to a cyclic turning point. Yeah, and therefore this change in trend could be related to a cyclic turning point related to a dominant cycle. So we not always need to look for this theoretical sine wave. Also, this trend turning from no trend to significant trend, or vice versa, is important. And then we have a third a change in trend, which is also related to cycles, but not as simple as often referred to in cycle analysis. That's the trend magnitude change. So a trend turning between two same sine trends. So, and let me explain. Maybe we have a slow upward moving situation, yeah, and then it changes to a strong upward movement. This is also a change in trend. A slow upward moving cycle, and then a strong upward moving cycle. So, and this could be related to a short-term dominant cycle. It's not as visible in the price chart as that. So you might wonder, why it's just a change in an uptrend. Yeah, but maybe set this into context of a long-term uptrend, maybe a multi-year uptrend, as we had for the last decade, a multi-year uptrend. So if we then have a slow uptrend, which on a shorter term period, which is then switching to a strong uptrend, if you detrend this information, this will become a downtrend going to an uptrend. I hope you can follow me here. But so therefore it's important also detect the trend turning between a slow upward and a strong upward, or even vice versa, a slow downward movement and then switching into a stronger downward movement. This is a change in trend magnitude, which could also relate to a cyclic turning points. So therefore, a trend change is not simply from upward to downward. A trend change is related to these three possible change in trend types. But that's just some basic analysis. I just want to highlight that because it is highly correlated to the analysis of cycles. If you just read this analysis of different types of trend turning, and I always try to explain it, it's not as simple as a classical sine wave. You need to have this in mind. And the RSD t-test, and that's what the research is about, if you go through all the details here, is one of the best methods available, and they compare their method to different other scenarios here to avoid false trend change detection. So they did a lot of tests here in these articles and research analysis, and there's even more out there. They tested against different other measurements. So the short learning here, and I don't want to dig into the details, is we are now able to apply the running slope different tests. Also, we don't need to use climate series. We could use price series and run the same method on that. This will help us to detect trend changes in the market related to the three types I just outlined. And let me give you an example on the S&P. It's implemented. The beta version is there. We need to just bring it to the user interface. But how does this look like on the S&P, right? I mean, that's the question. How do we use it? That's now the second topic I want to talk to. So let's run this analysis on the S&P 500 daily data. This is what you see here on this chart. The blue data is the S&P 500. I think 2 or 3 weeks old. And the orange line is the derived trends based on the detected trend turning points. Yeah, and the trend turning points are just the situations at the points where the trend turning was detected. And here you will find the different types of trend turning in this data series. So let's start here at the left. You see here we have a short uptrend or a small uptrend, which at this point in time here, is changing to a stronger uptrend. So it just looks like a simple upturn, but this point in time here could relate to a downward cycle or a bottoming cycle period, because it means from a slow upward moving to a strong upward moving trend here. And then all the way up to this point here, it was just analyzed as one cycle moving upward to this point in time here. And at that point in time, it switched to detecting a trend turning point, which showed a downtrend until here, then trend turning to a strong uptrend, strong downtrend. And here you see the same. From then we had a strong uptrend, and at that point in time switching to a slower continuous uptrend. So even that point here would match a top in one dominant cycle, not a composite cycle model. But if one of the dominant cycles is topping here, this could relate to this trend turning points here. One cycle stopped, then the strong uptrend, and then the overall trend just continued just a little bit slower. Then we had detected this top here, downtrend, these short trends. Yeah, and that's the way to go. That's the RSD t-test just applied on the S&P 500, which will give us trend information, short-term trends, not long-term trends. This will give us information on short-term trends in the S&P. And if we think about short-term trends relate to one cyclic movement, either upwards, downwards, sideways, or from slow upward to strong upward, and these three trend turning definitions. Now what we can do, and that's the key purpose what I want to show or move into the future, is if we detect the dominant cycle, let's assume the 80 days cycle, which I've just used here. And we always need to discuss the question when to trust a cycle. When is a cycle valid to use for a projection into the future? Because that's the key problem we need to tackle. Detecting cycles is easy in this digital signal processing world, and we detect lots of cycles in our data set. The key question is which to choose and which not to choose for projection purposes. And therefore, and that's then also related to the correlation. So it's not about the correlation about the raw price data to a cycle, but a correlation of the trend turning points derived from the RSD t-test results related to dominant cycles. And if we find a high correlation of these turning points from the RSD t-test turning points and the dominant cycle turning points in the past, then we have a match of two different methods. So the RSD t-test is just a method to detect short-term trends of different length in the data set. And if these turning points match or correlate to cyclic turning points of one or more of the detected cycles, this is another validation instrument to give us another indication if a cycle seems to be useful for projection or not. And that's how to use this method. We don't want to do trend changing approaches. I mean, you could use these RSD t-tests for different ways in a trading environment. That's what we are not here for. We are here for cycle analysis. And that's the key. So we can now analyze the short-term trends. And by the way, also the RSD t-test requires a setting for a given window length, what to use to search for the turning points. But we know the possible cycle lengths we are looking for, so we can use these detected cycles to choose the window length and then scan or run the RSD t-test with the dominant cycle length and then check if they match. If they match, they give us another indication, and we will put this into our artificial intelligence as just another feature, another measurement where the computer can have more confidence or can give us more confidence afterwards if we should pick this cycle or not. So that's why I think, and before this will show up in the application, I think it's important that you understand the concept. Yeah, because otherwise, once this shows up, you will have no clue what this is about. So therefore, I wanted to spend some time to explain what is the RSD t-test. It's a great method for short-term trend detection, which will then, in addition to cycles, help us to derive the most important ones. You will find the link in the description. You can Google it. You will find additional papers on that. It's already coded into our platform. It's just a matter of 1 to maybe 3 weeks until it will show up in our user interface, so you can make use of that. So let's spend some time on your questions. If you want, if you like, I'm open for a live discussion. So let me open up the chat section and feel free just to drop in your questions. So what do we have here today? Okay, so if the resolution is not best, I excuse for that. I need to cross-check if some chatting have changed here on my computer, so please excuse. Or maybe in the recorded version it should be better. So check it up afterwards. Maybe the live stream setting is not good. But Elliot, I will check this up for the next time. At least thanks for mentioning that. Erik, surprised about the cycles you choose. The Bartels of the 81-day cycle is far below 80, and some of these cycles even have a red triangle and still lower Bartel score. Yes, I think we had a similar question last week on exactly that topic. And I have in mind, I spent a lot of time on explaining this last week, so please also move back to last week. But for sure, let's spend some time again bringing that up. I don't want to ignore your question. Let's just bring this on the screen. Let's clean up here the mess first. Okay, here we are. Let me bring this in. Hopefully you can read the numbers better with this solution. I really need to check if I've changed something, but at least let's try it for that. Yeah, the Bartel score is low, and I remember it was exactly the same question as last time. So the Bartel score is below 30, or what you mentioned is even the other Bartel score are quite low. So the reason to pick these cycles, if you just go with the Bartel score from the spectrum, let's make this even larger. I need, Eric, I need to remove your question from the screen for a second, just a moment, but then let's spend some time on that. Oh, sorry, here we are back. So the green triangles represent high Bartels scores. And red represent bad or not so good Bartels scores, and blue is in between. So the blue triangle means the Bartels score, yeah, is low. And if you're just looking for a good Bartels score, you would go with these 3 shorter term cycles here, 50, 56, even 60. But as I said, just looking from the shape here, it's quite hard to choose which one to pick, as they are very closely related. And from the visual shape, maybe it's not good to pick them, because you see they are not as sharp in the spectrum, even though they have big green triangles. That's right. The visual shape in the spectrum would not make me believe to pick these cycles. And the amplitude, yeah, they have a quite low amplitude on that level here. So even though the Bartel score is good, from the amplitude and the shape in the spectrum, I would not go with these cycles. These 3 or even 4 cycles here look much better just relying on the shape in the spectrum. Yeah, and that's what I always said. Bartel score, it's just a statistical significance, or a test of statistical significance, which has nothing to do if a cycle is there or not. So what this means, or maybe, and that's the key reason just going by Bartels, you need to pick one of these 3 cycles, but which to choose? Very close related. Another reason is, and I've shown this in the introduction, even though it doesn't matter which cycle to choose here from these 3 or 4, they will all reflect the same projection, which gives even more confirmation to use them. And last but not least, to make it short, the Bartels score, as said, is statistical significance. So we need to detect a cycle first, and then second can check the statistical significance, which is low. Yeah, so we need to be careful with these cycles. But statistical significance just means that looking at past repetitions, the stability of this cycle in the historical data set from a statistical perspective is not as good. That's the statistical test for significant. So these cycles are not very static in the historical data set. That's more or less the reading of a low Bartels score. But as in, and this is what you often see, so these are very young or new cycles, which have not been dominant and static there in the data set before. That's the interpretation of a low Bartels score. But it does not mean that they are not there. So, and as it looks like the market dynamics somehow changed in March, April, I always told you in March, April, there's something happening which cannot be explained by the cycles based on that point. So maybe new dominant cycles have more or less coming into play, which have not been as dominant as static in the past. So the Bartels score will not detect or will not give these cycles a strong score. But as you see from other measurements like the amplitude, the shape and the spectrum, at this point in time of the analysis, these cycles are even more important than just the ones with a high Bartels score. So that's always the decision-making process we need as an analyst need to take into account, that there's not only one ranking or one measurement which will tell us which cycle to pick. So Eric, I just wanted to add a little bit of background information, what a low Bartels score means and why in that case. I think as they are more or less all with a low Bartels score, so maybe that's also a reading, we should ignore the Bartels score here. And these 3 ones just with a good Bartels score, they just look not good from a cycle detection perspective, even though they are not ranked by our computer guided mechanism. But that said, if you're just interested in historical perfect fit, then you should give the Bartels score more scores. If you are not interested in perfect fit into the past, then maybe the Bartels score is not the key measurement you should look after. I hope this helps a little bit, and I would also refer, I think last week Monday I also talked on that. Eric, okay. Yeah, and to follow up on your second question, what cycle do you use for the RSI cyclic smoothed? Yes, as I just, I will clean up the window in a second here. As you've seen, I have chosen just the 80-day cycle for the analysis before I switched on the cyclic smoothed RSI. And yes, that means it has used half of the length of the dominant cycle, which is then 40, or the half of the 81 days. So I think 40 was used for the calculation of the RSI cyclic smoothed. Okay, maybe another interesting question here. If 2 stocks have a high correlation and one stock has a clear spectrum, can we use the cycle of one stock to forecast the other stock with messy spectrum? Very interesting question. So first I would say, I would cross-check if these stocks are in the same sector. So, for example, the tech sector. this would be one precondition. Otherwise, I would not, or you should not use the spectrum to make a decision on the other stocks. So if they are coming from completely different asset classes, then I would not. But maybe this is also related to if they have a high correlation. So this would mean they're coming more or less from the same index sector, which means they will anyhow have a high correlation. Just because they have a correlation, I would not use this spectrum, because this could just be by chance, or I don't know what the reason is, because they have a high correlation. So correlation alone is just a mathematical score. If they are coming from the same sector, I think it's a valid approach to follow. I cannot confirm if it works or not, but it's a valid approach for cycle analysis. So for assuming you are in the tech sector and analyzing key stocks in this tech sector, and maybe one stock in this tech sector has no clear spectrum, I think that's your question, and another stock in the tech sector has a clear spectrum, you could then more relate to the analysis with a clear spectrum. However, I would be very careful with that approach, because even analyzing individual stocks will bring in more noise into the analysis. As I said, analyzing a single stock always means you have the risk of having more individual events coming into the price series. So cycle analysis has to deal with more noise, short-term impacts, which are not related to cyclic movements. And therefore, it's always harder to detect cycles in individual stocks than in sectors or even larger indices. So this is at least give a little bit direction if it's coming from the same sector. If we have a huge volume traded in these stocks, yes. If they are not from the same sector or asset class, if you don't have high volume, I would not use this assumption. But at least hope this helps a little bit. And Andrea, the trend detector will look at the dominant cycle length and project possible trend changes given a measure of how important the trend change will be. Yes, in general, you're right. So the dominant cycle length is coming from the cycle detection. So this gives an indication how to run the running slope difference test. Yeah, so we know what short-term trends we want to look for. And then the trend detector used with the RSD t-test will then check if there are real trend changes in the underlying price series related to the dominant cycle we are looking for. So, and then we can match the correlation of the turning points of the theoretical dominant cycle and the real changes in trend. And it's not just up, down, down, up. I explained the three different types of trend changes. We then check if the past theoretical cycle turns are in alignment with these three possible trend changes derived from the RSDT test. If we have a high match of the past changes in trend with the theoretical cycle, then it's a measure of how important that cycle and trend change is also moving into the future. So that's how could we rely on this cycle, yes or no. So your understanding is correct. I just wanted to also explain it with some different words. But as I understood your question, you are exactly on what we're trying to do here. Brand was published in April 2020. Yeah, so Brand, right, you will find one or two papers which have also used this analysis for some trading approaches. So you could use it to analyze short-term and long-term trends. You can then derive trend following methods, which is a complete different subject, yeah, not on this channel here. So if you search, do a little research on that, but there's not so much on there. I think that's about, this is not a simple, like a technical indicator. that's not so simple to code into a trading algorithm as an indicator, do some back testing, and up you go. The running slope difference test really requires a little bit more data number crunching upfront, and I think that's the reason why it is not taken into account by traders, because I think traders will fail at this approach. It requires a little bit more mathematical and scientific background, but at least your question is right. So I would recommend everyone just Google a little bit around this method, because it's not only related for cycles. If you are able to detect trend and trend changes, for sure, it could be used in different ways to push some trading algorithms. But I would count, if it shows up in a scientific magazine 2 or 3 years ago, it's a very new method. So it will take some time to get into the trading community. And I think the original method is from 2019. So it's really a new, from a scientific mathematical perspective, it's a very, very new method on that. But do some research on that. And you are on the right track. And maybe to follow up, will it also give a projection of the trend detector, how you called it, so the running slope difference test, will not give a projection. So it is not useful to make trend projections. So therefore, this is where the shortcomings of this method is. Oh no, my camera has broken down. So I think it's a sign we need to close this session. But sorry for that. But so the trend detection just helps us in the past, yeah, to rely on a cycle, and then the cycle is used to give a projection. Okay, so as I see, my camera has heated up, so we have hot summer here in Germany, and we are running 45 minutes. I think that's a sign to close the session for today, and therefore let's just use the opportunity to thank you for joining me today, and I hope to see you in a cooled down environment next week. Same time, same place. Thanks for joining me today. Hope you have a safe week. See you next week. Bye.